Welcome to Your Business, Your Life with Matt DeFrancesco, your personal financial technician. Whether you've had years of success in your business or just starting out, Highlift Financial can help you create a vision for your business, life, and family, and align these for generational wealth. So as they say, what happens in your life affects your business. And now, on to the show. Well, hello and welcome to Your Business, Your Life with me, Matt DeFrancesco. And actually, we're going to do something a little different today. And part of the reason is I get clients come to me to try to accomplish a lot of different goals, not necessarily just exiting or transitioning the business. But one of the big topics right now, it was an article I recently wrote in Body Shop Business about becoming an incidental owner, which is basically an owner where the business is not dependent on you. And have a lot of younger owners who aren't necessarily looking to transition out, but say, look, I don't want the business to depend on me anymore. So, one of the areas that I think is really important is kind of looking at how you're structured as a business and the different entity types to basically, mitigate tax liability, provide more effective transfer strategies down the road, and to basically allow the owner to maintain control without being involved in the day-to-day. So what we've decided to do is basically provide a series of educational sessions here to give you some ideas on some things to consider as you move forward on your transition strategy. So what I want to do is I'm going to break these down into about 30-minute segments just to make them more digestible. So you'll get a part now and then just kind of look, for the next session. And through all that, it'll be an easy way for you to be able to go back and reference a lot of the information. So anyway, so the first topic I want to delve into, and it's an idea that I think few owners think about, and it's something that really intrigues me. And I've been fortunate enough to meet Stuart Sorkin at a number of our exit planning conferences. And Stuart's just very knowledgeable in business entity types. He's an attorney and a CPA, does a lot of work in the collision industry. He's the founder of the Business and Legal Advisors, which is a business consulting firm that helps with strategic transfers and for a lot of collision shops here. And he's got a book out. It's called Expensive Mistakes When Buying and Selling Companies. I think it's a great read. It talks about all the number of mistakes that most people make. Anyway, so I'm really excited to have a Stuart on the program. So Stuart, welcome to Your Business, Your Life.
Well, thank you for having me. I can say one of my first major client when I left public accounting and went into the practice of law was a body shop.
Yeah.
It happened to be Mike Anderson's father.
Right.
And I have represented Mike and his father through shareholder disputes, transitions, and sales of businesses, and started there, and now have worked with probably more than 50 different body shops spread out throughout the country on succession planning, growth planning, getting your business ready for sale, or getting your business ready where you can become, my term is an absentee owner.
Right. Yes, exactly. I use the same too. So it's and there's some that still want to be involved. So either way, the terminology works. So
Correct.
Give us a little bit of background. So I think what's really interesting now, we've just kind of come out of the election, and I'm actually going to share some slides here that Stuart's put together. But I think let's talk a little bit about where current tax law is, because we want to talk about comparing some of the different entity types that are out there. So Stuart, let's talk a little bit about current tax law and what some things that
color based on what has just transpired.
Correct. Exactly.
Okay. As of 12/31/25, a number of the provisions of the Tax Reform Act of 2017 disappeared. Of importance to most body shop owners who are set up as S corporations, the qualified business income deduction disappears starting in 26. The maximum individual tax rate goes from 37 back to 39.6. The current lifetime giving exemption will go from right now, that actually is going up next year to 13,910,000 to one half of that, or about 7 million. The one permanent tax cut in the 2017 Act was the cut in corporate tax rates to a flat 21%. Now, in light of where we are with the election, it is quite possible that the Republicans will be able to extend these provisions, which were set to sunset next year. So I think when looking at this at this point, it's a mixed bag of whether you should plan as if it's going in 2 years, we're going to have the same law we have now, or whether or not we may have the phase-ins come in. So I think that's something to consider. But the big issue that I want to talk about is that it's not only how you operate your business of whether or not you should be a C corp, but it's also who is going to buy your company,
Right.
because that will affect the structure of the transaction.
Exactly. Oh, yeah, that's so true.
So the idea is that, as I tell clients, exit strategy begins the day you start your business, because if you don't know where you're going, how are you going to get there?
One time I had Mike on and he made that comment. So I'm not sure to attribute that to Mike or to you. So
Well, actually, I will attribute it to the actual author, which is Lewis Carroll, because it's what it's from Alice in Wonderland. It doesn't matter which road you're on, you can't get lost if you don't know where you're going.
that's right. That's okay. There you go.
It's a play on that.
Right.
In any case, so the concepts here are that if you're going to be selling to a third party,
Mhm.
it's likely you're going to have an asset sale. And
Correct.
that would pay you more towards an S corp, though there are some structuring things we can do.
Mhm.
If you are looking at a family sale or a management sale, there is no reason why it can't be structured as a stock sale to maximize the tax benefits, but it's that you will get when you are a C corporation until you exit, because there are
Right.
significant benefits that can be offered there.
Right.
If you are clearly going to be an absentee owner, a C corp makes sense,
Yeah.
because you might as well. But here's a point that I think that I find a lot of body shops take out their tax distributions and keep the rest in the company.
Right.
Now, if you are doing that, you are costing yourself somewhere between 16 and 23% in additional taxes.
Wow. Wow. That's
Because if you're going to keep the money in
Mhm.
the company gets state deductible state income taxes. So I just got in this discussion, I think in California, it's probably about 27%.
Wow.
Now, if you look at the tax rates are going to go up, take that from 39.6 and state income taxes that can run up to 10%.
Mhm.
Now you're talking about being in, so in one case, you can invest 75 cents after tax dollars in your business.
Mhm.
In the other case, you're getting 50% after tax dollars to reinvest in your business.
Right. It's
So it's the real concept is reinvestment,
right.
and is the ability to reinvest the funds.
Uh-huh.
Now,
Well,
this is
before we go any further, why don't we do a comparison on the different entity types? So, because again, I think a lot of the listeners, like you said, like most body shops are S corps. They don't understand the different.
okay. Let me give an overall view that this is really the benefits of each, but let me start off with a simple set of things.
That's cool.
An S corporation does not pay taxes. An LLC does not pay taxes. The owners of that entity pay taxes.
Right.
With a C corporation, the entity pays taxes, but the owner of a C corp can be treated exactly like any other employee and receive any other types of employee benefits, which is not true in an S corp. Your benefits are limited, and in fact, you have to like recapture your health insurance costs.
Mhm.
So the concept here is that There are certain advantages of with a C corp of being able to be for the founder or the owner to be treated as an employee.
Right.
And so one is you don't have to add back on your term. Two, if you are a single shop with a few employees, you can put in a medical reimbursement plan that will cover non-deductible medical expenses that can be paid as a benefit to you and the other employees.
Mhm.
I had one client whose daughter had a substance abuse problem, and over a 2 year, he put in close to $50,000 in medical expenses that Uncle Sam paid for that they wouldn't have paid for had it been an S corp.
Interesting.
Okay.
Hmm.
But probably one of the other big areas is this. In most cases, when I'm seeing a family or a management transfer, the founder is already reasonably financially secure, or he wouldn't be considering probably the transition.
Right.
If he is reasonably financially secure, the big problem he's going to have is how is he going to get paid fair market value from his family and or management and not saddle the company with a tremendous amount of debt that's going to affect their ability to these people to run it going forward.
Hmm. Okay.
So the concept here is that if you can build up cash within the company using the lower tax rate,
Hmm.
you can use that company for it to redeem the stock of the founder. The founder gets his capital gains treatment, and the new people only have to buy what 1, 2 shares potentially, so they're not personally strapped.
Okay.
Their risk is limited to the company, but the company, their salaries are capped at the company at that point until the loans are paid off. But the concept here is if they did it as an S corp, as they're making money, they're paying more taxes and they're giving all of the disposable cash to the founder to pay him off
Right.
at their potentially higher tax rates than the corporation.
Right.
Let me break it
And
down further. The concept is this, that if Mr. Founder is making, let's say, $750,000 a year,
okay.
and he's living after tax on 500,000.
All right.
If he invests, he pays tax on that 250. So that leaves him roughly, let's say 150 to invest.
Hmm.
And then he has to pay 40% or greater on that investment income.
Hmm.
Now, instead, he keeps that money in the company
Okay.
as a reserve for future acquisitions or to fund a non-qualified deferred comp plan or for various other reasons.
All right.
So now instead he can take that 250, that 250 is only paying a 25% tax rate. So instead he's got nearly $200,000 to reinvest.
Okay.
And he could invest that if he invests that in publicly traded stock, there is a 50% dividend exclusion available to the C corporation.
Okay.
So his effective tax rate is 12.5%
Mm.
on the money he's keeping in the company.
Okay. Instead of the ordinary tax rate.
And then that cash can be used subsequently to say, Mr. Founder, your company is, let's say, over a 3-5 year period, we accumulate $1 million.
Hmm.
Company's worth 2.
Right.
So now the company can buy 50% of the company, and the new people only have to pay for 50% of the company. Because the company, when the company redeems the stock, The stock is only what's outstanding.
Gotcha. So it's only outstanding shares.
Correct. And so you've reduced the number of outstanding shares. And so I've done this in family deals where son buys one share for $10,000 and the
Okay.
company has a $2 million note.
Oh, but they're holding that in
Partially,
cash?
well, part of it's paid in cash
Right.
and they've got the deferred comp piece that's paid out, but the balance is a note from the company.
Hmm. Okay.
Okay. So
Right.
that's so that way, and here's the other point. One of the other issues that we find sometimes is when you are dealing with management more than family is if they have to go to the bank, they may have to pledge their house.
Right.
Their spouse may not be very happy with that concept. And I have seen deals fall apart because of this. This is a way to potentially give seller financing.
Okay.
Now, because this is a C corporation, we have another alternative.
Hmm.
Instead of necessarily them buying him out, they get the common voting stock.
Hmm.
He gets a preferred stock that says X% of the profit of the company redeems him every year based on the then value. So the point is that as the company grows in value, he's participating as part of that. The advantage for the company is, unlike a note, there's no fixed payment.
Okay.
If you don't have enough to declare the dividends,
Right.
no dividends are the stock can't be redeemed.
Mm. Okay.
Let me raise one other issue,
Yep.
and that is that I'm seeing if you are growing, I've seen several cases where guys who are older have sold their businesses and they've gotten past their compete period and they want to be involved maybe as an investor.
Right.
Okay. Most investors do not like S corporations because they get phantom in. If you don't distribute the cash to pay the taxes,
Mhm.
they're out of pocket. They also realize that it's not exactly the optimum use of cash to have 40% coming out to them to pay their taxes.
Okay.
Plus, finally, most investors are going to say, that's fine. I'll go in as an equal partner with you. But if this thing goes to hell in a handbasket, I want a liquidation preference.
Right.
You can't do that with an S Corp
Mhm.
because that violates the second class of stock rules. The tax rate is one issue of why C Corps have value, but probably the other main issue is that you can create multiple classes of stock.
Right. Okay.
You can create a class of stock for an investor. You can create a class of stock for employees. This is something for those who aren't big enough to do an ESOP, but effectively want to do an ESOP.
Right. That's a good point.
That you can actually create that. Now, you don't get the tax benefit of an ESOP.
Right.
So if you can get to the size where an ESOP is worthwhile, you clearly can do it.
Right.
Another point about a C Corp is it does not have to have a 12/31 year end,
Hmm.
which means that you could have a October 31 year end and your bonuses, you get to choose as the founder when you take your bonuses. You can take them in the current year or push them off to the next year
Right.
because it's still deductible by the company in its tax year.
Okay. Interesting. To me, in my own mind, one thing I wanted to do here as you were talking was I wanted to kind of throw out some different scenarios to you and kind of say, all right, what is the benefit of doing a C Corp here, or is there a benefit?
Can I
Um,
give one more? I want to give one more
sure.
piece to before we get the question, Matt.
Okay.
And that is the estate and gift tax planning
Oh,
piece.
right.
To me, if you are, very successful MSO and you're pushing, a payday of 10 million, 5, 10, $20 million, you're
Right.
creating dynasty wealth.
Right.
If you are creating dynasty wealth, you cannot do that efficiently with an S corp or an
Mhm.
LLC because a trust pays the maximum ordinary income tax rate at $15,200.
Okay.
So it is not a great place to have ordinary income. But if you have C stock in an irrevocable trust, it gets the same favorable capital gains treatment.
Okay.
So you can pay dividends to the stock for that stock. You can also, the point is, it will also get the sales proceeds at capital gains rate. But the other point is you can put it into a trust that's growing for the benefit of your family and outside of your estate.
Right.
So there's a lot of potential in estate tax planning that can be accomplished with that because here's one last final point about gifting.
Hmm.
And that is the IRS, when doing gifting, recognizes the concept of valuation discounts for lack of marketability and lack of control.
Hmm.
So the idea here is that I'm doing this, I've got a client I'm just prepared an analysis for right now, where we think we can get probably a 25% discount. So he's going to contribute $2 million worth of stock and he's only going to use 1.5 of his exemption.
Oh.
So that amount inures to the benefit of the next gen.
Hmm.
Plus, if there's appreciation between now and the time he actually sells the business, that stock has appreciated.
Okay. Interesting.
And one other piece that along gifting, a lot of clients say, well, what if I need it?
Right.
Okay, there are two ways you can do that. If you are in a very secure marriage, the trust, you set it up in a trust,
Hmm.
you can name your spouse as a lifetime beneficiary. The trust can provide that it can lend you the money if you need it,
Hmm.
so you can cover it. But the ultimate thing is you could sell it to the trust for a note and decide later whether or not you want to take the money back.
Interesting. Okay.
But
Okay.
at least you fix the value by the note.
Right. Is there any way you could set that up as a charitable remainder annuity trust where
We could,
the
yes, we
stock
could,
and then they get income off of that, which is part of their liquidity event?
yes. And what the comment I make to clients is in most cases with a CRT annuity trust, I like the concept of usually twofold. If you contribute the stock itself, you're only getting basis.
Hmm.
You pay no tax, you build up this big pool of money, but you haven't gotten a shelter.
Right.
The idea of setting up a second CRT that you fund with some of the cash that you got from the sale that you're going to get a nice tax deduction for.
Right.
So therefore, you increased your pool. One pool is in pre-tax dollars. It's reduced the size of your gain, but there's no shelter. But having the second CRT provides shelter for part of the gain.
Okay. Interesting.
So it's a couple different ways to look at the process.
Right. I'm going to give you a couple of scenarios, and these are actually I'm not going to utilize anybody's names, but just some
Yeah,
real life scenarios that I
sure.
went into. So the first one is owner has a son in the business, a son that's not in the business. Basically, he has no intention of leaving. Like he wants to be kind of the 50,000 foot guy, almost like CEO, developing the culture, developing his employees. What would be the benefits of him going to a C corp?
The question comes in is this,
Hmm.
depending on his wealth, do we want to freeze the value of his, well, if he's going to stay there for a long time and
Right.
his son is growing it and he's already approaching an estate tax problem, why not potentially do some form of redeemable preferred stock that locks him in with a value rather than the floating value I talked about with the preferred?
Correct.
We lock in the value of his equity now. So son, who's growing the business in the business, gets a larger percentage of the appreciation.
Ah, okay.
And the preferred stock which is non-voting, could potentially then go to the other son as part of the equalization.
Interesting. Interesting.
Because you have to figure out how to equalize, that's probably one of the main issues is when you sell business to one child or a group of children and they're non-children, how are you going to equalize?
Yeah.
And what are you going to equalize? Because I would say that there are probably three main flavors I find in acquisitions, family ones. Dad wants the son to get the business and he really doesn't need the money, nor does he care about the money.
Correct.
So in that case, it's generally going to be a no long-term balloon that he's going to forgive at death. And the other kids don't get anything from that.
Right.
Okay.
Mm-hmm.
There are those that say, I need some income. But again, if I get my income and he's paid me, whatever's left, I'll forgive. Or if not forgive, I will forgive his, but everyone else gets a first out from the estate equal to the amount I've forgiven of the son's note.
Okay.
That would, because you want to avoid having children in a debtor-creditor relationship.
Gotcha.
And along the same lines, another thing that is usually critical in family transactions, Matt, that gets missed is they say, oh, well, I'm leaving the business to my son, to the operating kid, but I'm going to leave all of kids in the real estate.
Right.
The problem is that normal commercial leases would have a right of first refusal.
Okay.
Well, that really is a real penalty to the family.
Okay.
Because most people, if they know there's a right of first refusal on it, aren't going to make an offer because they know they're a stalking horse.
Right.
So what I insist in family transactions is a right of first offer, which says the family can say, hey guys, it's been nice, brother, but we want to do something. We want to cash out and do something else. Fine. Property's appraised. There's no broker. Quick deal. So it's appraised. He gets to buy it between 90 and 95% of fair market value. So you've protected the location without penalizing him.
Right.
But you've given a family the right to liquidate. And if he doesn't do it, then they can sell it and there is no future right.
Yeah.
So that is a real good way, something that gets missed in family and management transactions. Because in management, you can have the same thing. They'll sell the business, but not the real estate to management. And usually if you're selling to management, there's a legacy component. So you don't want your kids who are not in the business to necessarily put the management team that you want to make successful into an awkward position with regard to the real estate.
That makes sense. I think that's a good one. So here's another scenario for you. Got an owner who is late 40s, early 50s, owns the shop, is not looking at transitioning yet, probably not for another at least 10 years. Has got kids, but they're just in college now or late high school. So he doesn't know if the kids are going to be interested. He doesn't know if any of the employees are going to step up. Are there benefits to being a C Corp in that situation?
Well, twofold, I have to ask. Is he happy being a single shop owner or is he in a growth mode?
No, let's just say he's happy being a single shop owner at this point.
Okay. The only advantage that I would see that can benefit to him of a C Corp is if he is keeping money, if he is not taking all of the money, if he's keeping everything in the company except for his tax distributions, building up cash in the company for either a future acquisition or future acquirer sale, or that he can take out at a later date as a dividend. So it's the question is, if he's in the maximum tax rate already, and he is and he is not, doesn't need all of the cash in his hands, this is a alternative retirement plan
that
is very tax efficient.
Well, I think that's an important point because I think, at least this has been my experience. A lot of shop owners basically are paying themselves a salary. And then being an S Corp, they're just taking distributions as they need or as they want. So, and that can cause a problem because one of my guys I know, he's like, well, if I need to pay my taxes, I take a distribution. Oh, I want to buy a new Corvette. I'm taking a distribution. Um, again, which is not always the most efficient way of doing it. But I think to me, it sounds like, especially keeping cash in the company, this is much more effective way of being able to do that.
Not
Which
only
is, but they
that,
go ahead. Yeah,
but they could set up a credit line note with the company and borrow the money out at AFR and not even trigger income to themselves.
that was the point I was going to make. So all of a sudden, here it is. They want to be able to buy that hot Corvette. They would use the line of credit.
It's when I went in the company. Yep.
Okay, that's pretty cool stuff. That's pretty
Okay, but Matt, what I will say to you to tell everyone when you're doing tax planning, bulls make money, bears make money, pigs get slaughtered. Okay,
True.
so the point is, we are talking about planning here, and there's some really good planning advice that you can do. But don't overdo it. If
Right.
you become the test case.
Right. Well, and that's why I recommend to all clients, I know enough about this stuff to be dangerous. I can help to plant some seeds, but I'm always going to bring them to somebody like you, Stuart. All right. Because again, you can help us to determine what's going to be the best option for that owner.
And one thing I will say also is not generalizing too much, but most CPAs will question the concept of this.
I was going to
And
ask you about that because,
there are definitely CPAs who question the conference of this, but what I'm saying to you is regarding the two issues. Oh, double tax. Concept here is that if you have excess money in your corporation with a profit, you want to take it out. Not only have you paid a 21% federal tax, but you will pay a 15% corporate tax. I'm sorry, capital gains tax, which could be 20% depending on your tax bracket. The comment that I make is if a business cannot tell me, I don't know that I'd work with any business that couldn't tell me the month before year end within 3 to 5% what it was going to make for that year. I don't know that I would work with them.
mm-hmm.
So if you effectively look at yourself as an 11-month year, and then you say, okay, how much money do I want to keep in the company? Let's say it's 100, you want to put 100,000 away this year.
Right.
So you're going to keep 125,000 in the company. So you have the 25,000 you need to pay the taxes, and you have your 100,
Mm-hmm.
and the rest you're going to take out as a bonus.
No.
All it's cost you is the 2.9 Medicare.
Right.
So you can plan around the double tax on regular transactions. But that causes CPAs to actually have to do real planning rather than coming and telling you in April, oh, yeah, your K1, you're going to get extra 50,000. I got hit you through on your K1.
Right.
It's a little, okay. So now the other point, and also when you say double taxation, if the current rate is 37 and the corporate rate is 21 and capital gains is 15, that's 36.
Right.
It's
So still
not
paying.
actually even double taxed today.
Mm-hmm.
But the other point is why I say this works is after 5 years, you can always convert back. But if you are not going to sell to a third party, any other transfer can stay a C Corp.
Okay. Right.
And that's where knowing who you're selling to is important.
Right.
So that would be the issue there is who are you selling to? Because that and how quickly.
Right. Right.
Because the fact is that if you convert back and forth, there's also what's known as the built-in gains tax that runs another 5 years. So the point is that if you're in your 40s, you build up a whole bunch of cash in the company, till you turn 50, and at 50 you go back to the S corp with having all that good cash in there and tax in there,
Right.
and then at that point you sell the company
Right.
and get your S corp treatment.
Right.
So it's the question is, are you ever going to need to be an S corp again? And the only situation I think that happens is if you go to a third party, probably.
Right. Exactly.
Anyone else, you're going to probably be able to negotiate a stock deal
That's the
with, and potentially having to make, the 336 or 338 H10 election where, they'll write up the assets.
right. I think the key point is it's really important to start planning early. Okay. I mean, I get owners that come to me and says, look, I'm 68 years old. I'm burned out. My kids aren't interested in the business. I don't have any key employees. I just want to sell. Well, guess what? You've really got no leverage. Where if you've planned 5, even 10 years out, you have flexibility. So for example, I mean, I got one client right now. We're just in the process, but I kind of help them to kind of develop a, kind of a personal vision. And then I'm working the financial plan with them. It ran Monte Carlo simulation and told them, well, you know what, on your valuation, you got a gap. You're going to have to adjust your lifestyle. And I said, but if we can build the value of the business to this point in the next 5 years, we can do that. So now all of a sudden we've shifted looking at helping to build value in the business, the owner to become more of an absentee owner. And it would sound to me from what you're telling me that it might be of benefit for them to go to a C corp,
I'll
because
give
in
you,
5 years, if they do decide there's nobody available, we're going to sell it to a consolidator, they could just convert back to the S. Is
yeah,
that
there
correct?
are some tax negatives of
Okay.
doing initially.
Explain those.
What's known as the built-in gains tax, that you've
Okay.
sheltered the assets and there is a recapture of that benefit during, I think it's a 5-year period. I need to look it over a little more carefully.
That's fine.
But
Just on a high level.
yeah, this is the idea here is though that if you're not at your number, can you do it through internal growth, or do you have to become a strategic acquirer?
Right.
And if you're going to have to become a strategic acquirer, then the C Corp makes sense because you're going to have debt, which you want to pay off with cheaper dollars. You're going to want to accumulate cash in the business with cheaper tax dollars.
Right.
You're also going to probably be setting up a holding company where you can have employee class equity in a shop, or you can have employee class equity in the holding company that rewards those that are really affecting all of the shops.
Right. And I think that's an important point to make, because there is a number of owners out there who are looking to grow through acquisition.
Yeah.
And
And
so I think
growth
that,
through acquisition, here's the other point. If you get a good enough if you get your C Corps up to a large enough level, you will probably avoid having to have put up personal guarantees when you buy.
all right.
S Corps, it's impossible to get away from personal guarantees. Almost, because they know you can move the money between.
Okay. I get you.
But with a C Corp, if it looks like it stands on its own, you have a better chance of avoiding guarantees, or at least maybe getting lapse in guarantees that over some period they disappear.
Gotcha. I get you. So that's great. Hey, Stuart, this is kind of like drinking from a fire hose. So we're going to take a break. And in our next session, we're going to go into a little more detail, just showing some of the numbers and comparisons, differences between S Corp, C Corps, LLCs, and kind of dive into some of the ways to create liquidity out of it too. So, Stuart, I'll be looking forward. We'll be right back with you. To the rest of the audience, thank you for listening to Your Business, Your Life. If you've not subscribed to the podcast, click the subscribe button below. That way, when a new episode comes out, it'll download directly to your device. And also, if you like what you're hearing, give us a 5-star review. That way we'll get to more and more people. So please come back for our part 2 of this session with Stuart, and we'll look forward to seeing you guys then. So take care and God bless. Hey, I really want to thank you for listening to the Your Business, Your Life podcast. If you want to be notified when new episodes become available, click the subscribe button below.
All information is obtained from sources deemed reliable but not guaranteed. No tax or legal advice is given nor intended. Content provided herein or on our website should not be construed as an offer for investment advice or for securities, insurance, or other investment products. Investments involve the risk of loss and are not guaranteed. Consult a qualified legal, tax, accounting, or financial professional before implementing any investments or strategy discussed here. High Lift Financial is a DBA for DeFrancesco Financial Concierge, LLC. Investment advisory services are provided through Cornerstone Planning Group, LLC, an independent advisory firm registered with the Securities and Exchange Commission.